Hi, this is Alessio. Hope you're well, and welcome to this brand new update. Now, as you probably noticed, I have not posted any new videos on our channel for some weeks, but I really thought this is a chart I want to show to you. I think this is one of the most fascinating charts out there. And let me just say this, even if your main focus is only, let's say, the crypto charts or the Bitcoin charts, I think this chart will also fascinate you and interest you. And actually, it could have an impact on Bitcoin as well. In fact, in a few moments, we'll discuss Bitcoin very briefly at the end of this video as well. But let me just show you this chart. This is a 124-year chart of the stock market, of the Dow Jones Industrial Average. Yes, you heard me correctly. A 124-year chart. As you can see here, this goes back all the way to 1929, before the 1929 Wall Street crash. And yes, even the 19th century. This is the start of the century, just before the start of the century. As you can see here, this is 1899. There it is, just before the start of the 20th century, as you can see there. So a very long-term chart, which you may not have seen before. And there we are. We are now here in 2021. And this was the top here of 1999 and so on and so on. So you can see what I've done here. What I've done is I've connected the highs. Let's just zoom in a bit here. So what I've done is I have connected the highs, the 1929 top, before the Wall Street crash, the famous Wall Street crash of 1929. We've connected the highs there. We've connected the closing highs. So I'm using closing prices. And if you want to know what I mean by that, that means I'm using here closing prices based on a line chart. Let me just show you. You can go on a line chart, and you can see I'm using the closing prices, which often can make the trend lines more reliable and actually a bit better as well. So as you can see, again, I've connected the highs, the closing highs of 1929 with the highs of 1999, and we get this trend line which meets us right now very close to where we're at the moment. You can see right now in 2021. If I zoom in on that chart right there, let's just zoom in on that. Notice where the yellow line, the yellow trend line meets us. There we go. Let's zoom in on that. And you will see price action is now coming very close to the top of that trend line as I'm speaking. There it is. So the Dow is now coming extremely close, very close, as a matter of fact, to that yellow trend line. There it is, as you can see right there. Now, in case you're wondering, that trend line comes about, let's go on a weekly chart. It's a weekly chart of the Dow. That trend line, the yellow line you see there, comes approximately at the 33,500 level. So it's about 33,500, 33,400, where that trend line is coming to meet us, as you can see right there. Now, in case you're wondering, well, so what? So what if the trend line is meeting us? You could be wondering, why is any of this important? Well, here's why it's important. Let's zoom out a bit. Let's zoom out one more time. Let's go back in history. So there it is. This is our 124-year chart of the market, of the Dow. So you may be asking, why does it matter? So what? Well, the thing is that usually when price action, for the first time, comes to meet a trend line like this, again, we're connecting the highs of 1929 to 1999, meeting us right now in 2021. Usually in technical analysis, the odds are higher that when the first time it tests the trend line, when price rallies and comes to test the trend line, usually there's rejection from a trend line. So usually price gets deflected from that level, okay? And some analysts, again, some chart analysts are predicting what they're saying, that we could actually see after, in other words, after the price gets rejected from that trend line, which is coming very close right now, we could see the beginning of a major bear market like the one we saw in 1929, the Wall Street crash, which, by the way, you may recall, that famous 1929 Wall Street crash, let's just go to it right now. The famous crash of 1929 was an 89% crash, okay? So really from the highs there, or even from the closing highs, about an 89 to 90% crash we had from 1929 to 1932 in a major depression. So that was a depressionary cycle, as I'm sure you're probably aware, which brought about, as you know, one of the worst recessions and depressions in history, probably even on par with the one we're going through right now, if not even worse. But in any case, the bottom line is that some analysts, some chartists are saying that we could experience something like that after the Dow reaches that trend line and gets rejected from it. So we're not far away, okay? We're not far away. And again, the odds are, according to these chartists, that we could start a major bear market on par with 1929. In other words, similar to what we experienced back then, which could result in a major bear market crash, taking the Dow all the way down to the bottom of this channel, probably down to 11,000 to 10,000 on the Dow. I mean, we're talking about a major drop, major crash. Almost two-thirds of the Dow being wiped out over the next few years. Now, let me say this, guys. I personally disagree. I don't think that's likely. So I disagree with these chartists out there who are predicting this kind of catastrophic crash, that we're going to experience a crash like this year. So what these guys are saying is that this year, after the market reaches this level, this trend line, if we just draw this in a different color, for example, in a magenta line, for example, just connect this high to the 1999 high, you can see that's exactly pretty much where it's meeting us. We're close, we're not far away. So according to these chartists, we could experience a major bear market crash similar to that one in 1929 to 1932 after we reach these levels. And this bear market could, again, wipe out about two-thirds of the Dow and the S&P in the major markets, plunging the world into a depressionary, recessionary cycle over the next few years. Personally, I don't think that's likely. So I'm not expecting that catastrophic scenario for a reason I'll explain in a separate video. We don't have time for that in this video. In a separate video over the next few months, I'll explain to you why I don't think that's likely. I want to keep this video as short as possible, but as you can see here, we're not far away from that trend line. I think what's more likely, here's what I think is more likely, which is that once we get to that level, once we meet that level, the trend line resistance, it's probably likely we'll see a rejection, maybe some kind of correction and retracement. We might see a 10 to 15% retracement, perhaps. It's possible. We could see something like that. But a bear market lasting for a few years that could wipe out two-thirds of the Dow and the S&P, I just don't see it. Bottom line is this, guys. Here's the bottom line. Look, let's zoom in on that. Let's zoom in on that. So you can see we're not far away. That resistance trend line, again, puts it at about 33,500 approximately. Now, in case you're wondering, why does it matter? Well, here's why it matters, because according to the Elliott wave principle, which is a book, fantastic book, by the way, by Frost and Prechter. If you're looking for a good book on Elliott wave theory, that's a good one. The Elliott wave principle by Frost and Prechter. Here's what they say. They say that within parallel channels, so let's go over here and read this here. They say within parallel channels and the converging lines of a diagonal triangles, if a fifth wave approaches its upper trend line on declining volume, it's an indication that the end of the wave will meet or fall short of it. So in other words, let's go on this chart over here on the right-hand side. This chart is also, by the way, from the book, The Elliott Wave Principle by Frost and Prechter. They're saying that if price is rallying to the trend line resistance, like we're in right now, okay, then it's likely that it probably falls short of meeting the trend line and probably get rejected from it. It's more likely on declining volume. So as long as you have declining volume, then it's likely that it will fall short or perhaps just meet the level and then perhaps get rejected from that level, like you can see here. However, they say this. They say if volume is heavy, so if the volume is heavy as the fifth wave approaches upper trend line, it indicates a possible penetration of the upper line, which Elliott called throw over. So in other words, if we are rallying into this trend line resistance with increasing volume, it's more likely we're going to penetrate that line. So it's more likely the price will climb over and penetrate that line. And that's what's called a throw over. And by the way, they say over here that a throw over is confirmed by an immediate reversal back below the line. In other words, if price gets above this line, so if we climb above it and penetrate the line to the upside and then immediately then fall back below it, that creates a throw over, which becomes quite a bearish pattern. Let's go on the actual chart now. So here's the line, as you can see here. So let's say, for example, we climb over and penetrate that line here. Let's say the Dow does that over the next few weeks and months. And then very soon after, it closes back below it again like this, especially if we see follow through lower, below, let's say below the 32,000 level, then that could actually start a major correction in the price action. Okay, so in other words, so here's a weekly chart. Okay, let's have a look over here. So let's say the price action on the Dow, let's say we do climb over it and we get a throw over, which is looking less likely. I'll show you why in a minute. But if we then close back below the trend line again, that could confirm the throw over and could actually be quite a bearish reversal, starting a major correction. Again, I'm not expecting a bear market scenario like some chartists out there are expecting. I think it's less likely. But a correction is possible and indeed likely indeed. Let me show you why I think that one of the scenarios is quite likely. Take a look at this, Dow Jones Futures. So the chart of the Dow Jones Futures is showing this. We're seeing a rally So over the last few days, and we've seen a rally in the market, a rally higher in the Dow, making new highs. But look at this, volume is going lower. So we're seeing a rally over the last few days, but it's going higher on declining volume, on lower volume, and in fact, below average volume as well. So this seems to indicate what Frost and Prechter are talking about in their book, which is that, as you can see here, they're saying that if a fifth wave, which I think was what we're in right now, if that wave approaches the upper trend line on declining volume, it's an indication that the end of the wave will meet or fall short of that trend line. So we're rallying higher, but on declining volume, which is more likely will fall short that trend line, or will probably meet the trend line, but perhaps get rejected from that trend line is more likely. Okay, so that really is interesting. I mean, look at this one more time. We're coming close to that trend line right there. As you can see right there, we're not far away. And in fact, zoom back a bit. Let's go on the 124-year time frame. I'm very fascinated. Again, I don't actually know which path the market will choose. Of course, we can never know. There are no certainties in the market. But it's quite interesting to find out how the Dow, how the market could react to that trend line. Would it start a bear market like some chartists are predicting that could, take the Dow down by 2/3? The market could fall into a bear market like this. Or will it be just a correction? Will it just be a retracement, maybe 10 to 15% correction? Or could it be that price action will climb over and penetrate that trend line? In other words, could it be a throwover? So could it be something like this, that will just penetrate that line, climb above it here, and continue to go higher? Okay, or maybe a reversal from that level, like a false breakout. Again, nobody knows. It's pure speculation at this point. But based on Frost and Prechter's principles of a throwover and based on declining volume, like we saw here, again, a rally on the Dow with declining volume, this seems to increase the probability that will probably not go over above the trend line. So that seems to indicate that we'll probably meet this trend line, but probably not go too much above that level. Indeed, probably just see a retracement or some kind of correction from that level. Again, very fascinating. And by the way, in case you're wondering what impact could that have on Bitcoin, I really don't know. There are times when Bitcoin and the markets are correlated. At the moment here, there seems to be a correlation between the two. So there seems to be at the moment some kind of correlation between Bitcoin shown to you here in orange and the S&P here. But honestly, we don't know how the market or how Bitcoin could respond to some kind of a rejection or in some kind of a bear market or even a retracement scenario. Personally, I think that on the balance of probabilities, that if the price action gets rejected from that trend line, so if we do come to that trend line and get rejected from it, I think it'll probably put some downward pressure, some negative pressure on Bitcoin like we've seen before. Okay. Anyway, guys, very interesting and fascinating chart, and I'm looking forward to see what happens here on the Dow over the next few weeks and months when we do reach that level. Thanks very much, guys. If this video has helped, please give it a thumbs up. Thanks very much, guys. Again, please remember, if you're not subscribed, please do subscribe today, and also please hit the bell icon to make sure you're notified of our future video updates. Thanks a lot. Bye for now.